It's going in the right direction, and at what point does it start to match and level up with what we see in developed markets, do you think? What is the time frame?
When you look at the bond market, right, we still see massive growth potential because the stock of the stock as in the size of the bond market versus the GDP in China is only at 90%, where when we take a quick look at the G3 economy, the size is anywhere around 200 to 250%. So that tells us the bond market is underdeveloped, despite it being the third biggest in the world. So that's the excitement of even when this market becomes bigger, to properly represent the GDP, it has to be done through a much more market-driven securitization of the debt. That's on the balance sheet of a lot of big, mega, and regional and smaller SME-driven banks. And that needs to be more securitized. It then needs to be more market-driven in the pricing, because that's the whole point of securitization. So this development is, I think, undergoing a very tempered but careful, meticulous evolution right now in opening up and having more market-driven pricing.
And the inclusion of Chinese bonds on the Bloomberg index and other indexes, the impact of that is going to be what, do you think?
It's huge, right? Like for what's worth, we're very excited to hear that the Bloomberg Barclays Index has included the Chinese government and policy bank bond market into the index. And on top of that, we know that there are probably up to just the top 3 indexes, the total aggregate size of those. If you look at the impact for passive and active combined, the inflow could drive up to a 300 billion size in US dollar of inflow. Now that's hopefully is a start, because I think the market will further develop, as I mentioned, in size, in sophistication, and product category. And as more investors comes in, passive will drive active, active will drive the market peripherals, including, I would say, shorter-term trading interest and derivatives market. And it just totally enhanced the risk transfer and risk offset ability for banks and free up capital and liquidity concern. So this development is somewhere that global investors can play a key role on top of that 300 billion of a stock of cash coming through to help securitize product. But bring in best practices around the world of how we look at properly pricing and transferring risk, especially the more difficult, higher yielding, or even, let's call it credit event prone type of names. That's where I think global market practices would help this market develop much quicker.
And since I last spoke to you earlier this year, between then and now, what have you heard from clients in terms of their appetite, their enthusiasm for Chinese bonds? Has it increased, or are they starting to get a little bit more cautious now, given some of the macro environment?
Yes, Tom. I think people are very actively engaged in the dialogue. And I feel like we just have our Paris conference as well. We have a separate dedicated session talking about Chinese markets opening, especially the bond market. It's unprecedented, the level of anticipation and interest in this. But just as a quick look, right, 2018, the size of the bond market has generally grown in foreigner shares from anywhere around 1.6% to 2.3%. So that's pretty big move, right? On a very, very low base. We talked about smaller, like 90% debt to or bond to GDP. That market may grow, and the foreign participation would also grow exponentially from there. The number of participants, institutional foreign investors, has grown from anywhere from 800 to around, I think, around 1,100. That's just 2018. And that's before a lot of these discussions about the index inclusion that actively, Barclays, Bloomberg, ourselves, JPMorgan, as well as the FTSE Russells are actively looking and exploring. So I think it's when we look at all the signals from how the bond market development is all trending in the right direction.